Hey, this is Dave. Thanks for joining me for this episode of Living an Abundant Life. I am really excited about this episode. Today I'm going to start looking into commercial investment property. There's 5 key questions that I go through and ask of the property. I'm going to share those with you today. Buckle up. It should be a fun ride. As always, I'm not a financial advisor. These are questions I've used for my own research. I think they can be helpful. Use them at your discretion. See you in just a sec. So I purchased my first investment property all the way back in 1996. So that's 25 plus years of experience in buying and selling commercial investment property. My questions are to how to determine if an investment property has a positive cash flow. 5 questions, so there's information needed. Let's get right into it. Number 1, what's the total cost of the property? Number 2, how much of a down payment do you need? Number 3, what's the interest rate on the mortgage that you can expect to pay? Number 4, what will be your total monthly expense? And number 5, what's your expected monthly rent income? I have made some assumptions that if you're going to use these 5 questions, that 1, you have already gone to the bank to talk to them to see how much property you can afford. 2, you're looking at a property in a neighborhood you're comfortable with, an area of town you're comfortable with. And 3, you're buying a property that already has a renter or you have a renter lined up. Those are 3 key points. If you don't have a renter lined up and this is your first investment property, it's going to be pretty tough and it's going to be pretty stressful. I really encourage you to get those 3 things answered. All right, let's look into these 5 questions in a little bit more detail. So what is the total cost of the property? So first, what's the purchase price? Are you going to be able to offer a little bit lower? Do you need to come in with a full price offer? What's the cost of any repairs or renovations that are going to be your responsibility? And 3, what are the closing costs? How much is your down payment going to be? You're going to want that down payment to be as low as possible. The minimum that you're going to get into a property for, though, is 20% down. On investment property, the banks really are not going to talk to you unless you have 20% of the purchase price. Now, you may have some arrangements with the bank or you may have some other financing opportunities, but if you're going to go to a conventional bank, they're going to be looking for at least 20% down, probably as much as 30% down if this is your first project. You probably should begin your penciling out at a 25% down payment. What's the interest rate on the mortgage? You can go to your bank and they can give you some parameters on what that number will be. A good rule of thumb, though, is that you're going to pay 50 basis points higher than what a conventional home mortgage is running. So let's just say that you could get a conventional 30-year loan on your home for 4%. Well, you can expect to pay at least 4.5% for commercial investment property. That's probably where I'd start, is that I'd look at 50 basis points above whatever the current home mortgage rate is. What are the estimated monthly expenses? So these are actually your fixed costs. These are costs that you're going to know pretty much beyond a shadow of a doubt. So first of all, you're going to be able to figure out what is your monthly mortgage, your principal and interest payment. Number 2, you should be able to go to your insurance agent and find out what is your monthly insurance cost going to be. And number 3, what is your monthly property tax payment going to be? Now, depending on what kind of property that you're buying, you may be able to pass those last two expenses onto your renter, but you at least need to be aware of them when you're first looking at the property. Lastly, what is the expected monthly rental income you're going to get? If you have a tenant already in the building, you're going to have a history of what the rental income is. You can use that to gauge how much you're going to be expecting on a monthly basis. If it's a new building, you're going to have to find a tenant. Again, I would recommend for your first investment property that you stay away from those. That could be a headache for you. You want to buy a property that already has a tenant in it with an established rental history. So now that you've answered those 5 questions, let's look at an example. So this is just a deal similar to something I've done in the past. The purchase price of the building was $375,000. I estimated that it was going to take $18,000 of repairs or renovations, and then I estimated $7,000 of closing costs for a total of $400,000. When you start doing more and more of these deals, those estimates, you're going to have them down pretty quickly, and you're not going to be that far off. But in the beginning, you're going to want to be pretty cautious on those extra expenses, the repairs and renovations, and the closing costs. And then also, as you get more and more information, you're going to want to keep doing this analysis just to make sure you're covering all your bases. So we're looking at a building, though, that's going to cost $400,000. So total cost of the building, $400,000. Down payment, like I said, you're probably going to need to expect 25%. So that's a $100,000 down payment, leaving you $300,000 to finance. At a 4.5% interest rate for 30 years, your monthly payment will be $1,657. That's your principal and interest monthly payment. Then you need to add in your property tax. For this building, I estimated $350 a month in property tax. And then your monthly insurance is going to run about $85 a month. That again depends on how much the building is, what it's worth. You can very quickly get a good estimate by calling your insurance agent on that. So the total fixed costs, you know these costs every month, look to be $2,092 per month. Now we need to add in some other expenses as well. You need to reserve for a vacancy rate. You need to reserve for potential repairs and replacements that you're going to have to do. And then you may want to have a property manager manage your property for you. In this instance, I estimated $550. This was going to be roughly 15% of our rental income. That was a rule of thumb we were using. So it's 5% for vacancy rate, 5 to 7% for reserves, and then somewhere in the neighborhood of 3% for the property manager. This came to a total expense every month of $2,642. So for this building to have a positive cash flow, the rent's going to have to be at least $2,643. That's very risky. You want to make a profit on your down payment. You want to have a cash on cash return on your investment. So in my example, I was looking to see, could I get a rental income of $3,058 a month? What that would do is that would give us a cash flow, a positive cash flow of $416 a month, or roughly $5,000 a year. That came out to a 5% return on your $100,000 investment. You then need to decide, can your building support this? And is this enough cash flow profit for you? If this information has been helpful for you, please subscribe, hit that like button, and I look forward to seeing you again. Thanks a lot.